What do you think the outlook is for US Treasury yield?
Well, I don't think there's going to be much of a change. Normalization's going to be very much to bridge by what the U.S. economy does, and the U.S. economy is growing very, very slowly. Here's an interesting perspective. 1948 to 2009, the average GDP growth quarterly, 3.4%. Since 2009 to the present, 2.1%. All right, there's really no material signs of inflation. The economy is just, it's growing and it's solid and dependable, but there's really no catalyst to, drive the Fed to be so restrictive as to basically, accelerate normalization. So, I think people get ahead of themselves, and they've been doing it for a while, for the last couple of years, anticipating the Fed would do more, and then interest rates would go up.
The Fed was ahead of the market, and the Fed rode back to the market expectations. So what is the view now on this one interest rate hike that the market is looking at for December? In your view, is that too much of a hike given the slow growth we've still got in the States?
Yeah, I wouldn't be surprised if the Fed does nothing. I mean, market has, when does it get normal for people to all but expect something and it not happen? Yields will be, generally where they were for the last 2 years in January, this year around the 10-year. We at, S&P Global Market Intelligence, right, we don't see a lot of catalysts for why things would change. We don't see why valuations would change with equities. We think that the risk curve will remain distorted. There will be asset inflation in equities for the foreseeable future because the world is starved of yield.
So if you compare what we're seeing in the bond markets relative to what we're seeing in the equity markets, then you've seen this natural push of risk into equity markets because actually the return is better. At what point, if we do see a further shift higher, does that change? Because the way you're talking, it suggests kind of that it won't. So it's only nervousness or some perception of valuation that then triggers some kind of pullback.
Yeah, I think that's a real question, and that's what we try and identify. What's the event? What's the event that's going to drive those interest rates higher? And you're absolutely right. There could be as much as $2 trillion of asset value within equities that probably should be in bonds. And it's interesting. I had this very conversation yesterday, so I hope I sound rehearsed. But basically, I was explaining how fundamentals just don't really matter anymore, particularly with equity valuations. Right now, that's a backseat issue. We have, for this quarter, particularly in the U.S., but we have slow growth in the Eurozone as well. We have anemic growth. This quarter right now, reporting, we are about 1% positive growth for earnings. Now, the good news is that's better than the 4 negative growth quarters we just came from. So we broke that, right? But 1%, yet we trade at almost 17 times next year's earnings. Now, I'll give you a little historical perspective on that one too, right? Bottom line is that you usually get about 7% with the 15 to 16 times next year's earnings. So we have no growth and a higher valuation. How do you reconcile it? Just because everybody's piling, you get better yield by buying stocks than you do bonds.